joined by market veteran, Mr. Krishna Memani. Krishna, good evening to you and thank you for joining us. We indeed are living in interesting times. I guess the word interesting can be constituted in many ways.
Interesting indeed. The global economy is going through a down leg, a drawdown that none of us have ever seen, probably the worst in the century and therefore probably worst in the history of humanity. It's synchronized, it's global, and nobody knows how long it'll last. Interesting indeed.
Now, you understand the dynamics of India more than anyone else. Do you think the current lockdown policy which the government or the administration has adopted, do you think that is going to backfire? Of course, this is good, this is great, survival first and revival later on. But in reality, whenever the economy will open, do you think India will lag global growth?
Well, so I think the challenge for the Indian economy is going to be severe for sure. The Indian economy was slowing getting into this situation, and the lockdown certainly will make the situation far worse. Having said that, as you said, the primary thing that the country needed to focus on is to make sure that it didn't spread wildly, because if it did, the outcome would have been worse because it would have taken a whole lot longer to contain it. Hopefully the lockdown has helped contain the problem, or at least minimize the problem, and therefore the impact is manageable. The advantage India has relative to every other country is it was still the fastest growing economy in the world, despite the fact that it was already slowing. So coming out of it, the trend rate is something that we can rely on as long as the government implements a good set of policies.
Are you a bit surprised with the strength global markets are exhibiting? In last 15 days, I have used panic and FOMO together. And I frankly don't remember when was the last time I've used panic and FOMO together.
No, that's actually the $64,000 question. That is, why are the markets reacting the way they are reacting? And I think there are two primary reasons. One is a combination of the policy mix, which is probably the most aggressive, at least in the US, for example, than they had implemented even during the financial crisis, which was the last big drawdown that we saw. The reason I think the markets are reacting the way they are is their expectation is at some point things will open up and it'll be a V-shaped recovery. I think we can debate that and we won't know the answer for a while. Much the way getting into the current crisis, the market was positioned for perfection. I think we are at the same point. Having said that, I think if the recovery is quick, the market valuations may not prove to be excessive.
Will you be surprised if the March lows are tested again?
No, I wouldn't be surprised. In fact, for my personal portfolio, I'm waiting for that. That is, when it was down, let's say 30-35% in the US, for example, I think valuations were improving, and therefore it was a good opportunity. At this point, I can't really say that I want to put any new money into the market. And if that's the case, I think the risk is on the downside far more than the upside.
Do you think the biggest risk for a long-term investor right now is the risk of not remaining invested? Yes, of course, markets could go down. That's the risk to your portfolio. But the other risk is that markets recover and you underperform?
Well, so if you actually go back and look at the history of these types of drawdowns, what you find is if you are out of the market, getting back into the markets are probably the toughest thing, because you're always thinking that it'll test the lows that we saw 2 months ago or a month ago or 6 months ago. So I think for a long-term investor, the strategy really has not changed, because if you invest, even if the markets have gone up somewhat, and stick with it for a long period of time, the returns are actually quite spectacular. And that has been the case in every drawdown over the last 60, 70 years.
Even though we've not seen a big breakthrough on medical news, everybody is hoping, all of us are praying for a medical breakthrough. Do you think markets are already pricing in a mild recovery and a meaningful breakthrough next 6-8 months?
Well, so that is really the key question. That is, the markets are certainly pricing that, because if that wasn't the case, then we will probably see the second wave. And if we see a second wave and we get to the same situation where they are locking up parts of the world, again, then the problem is going to be more from a longer term perspective, be a more acute problem. So I think one of the assumptions is that the medical community, the biopharma community, will find a solution and find a solution relatively quickly.
So if bears, they insist that, look, the genie is out of the bottle and governments have already fired the last bottle, they will not be wrong. I mean, can I say that best of the government action in terms of stimulus, interest rates, everything is now known?
Well, yes and no. So the actions of most fiscal authorities and monetary authorities really has been quite substantial. Having said that, I think they have a lot more flexibility. So if the current period extends from a virus spread standpoint, then I think they will have to do more. And they have more things that they can do. So 10% of GDP in the US in a stimulus is very large, but if it extends, they have no choice but to do more things. And we are talking about 15, 20% of GDP before we are said and done.
Do you think India has lagged behind? Because up until now, we've not seen, heard, or got a sense of a large stimulus?
Yes, no, I think that is one of the biggest, I think, policy errors that India could be making. That is, locking down the economy for as long as they have. For it to come back, they have to provide a much bigger stimulus, both on the monetary and fiscal side, than they have so far. One of the constraining things has been the fiscal deficit, but I think if there was a time to ignore that and make sure they do all the things that they need to do and recognize that the markets have, or global markets have no choice but to cut them some slack, I think this would be it. So the Indian policymakers, again, both fiscal and monetary policymakers, need to do more, a lot more than they have done so far.
So what currently would be a market of choice? Because sitting there where you are right now, you have a choice to choose and perhaps allocate capital to whichever part of the world you want to.
So I think there's a short-term thing and there's a long-term thing, right? So from a short-term perspective, developed markets probably come back first because that's where the current production can ramp up and the down leg is probably more manageable, and the stimulus and policies will be far more conducive. From a longer term perspective, countries like India are actually in a much better place today than they were earlier. And that sounds really odd, but the reason for that is the growth differential, at least the trend growth rate differential between Western countries and India is going to be far more acute, far wider than it was before the crisis. US coming out of this, if the trend growth rate gets to 1%, that'll be a good outcome in my judgment. India, on the other hand, if they implement the right policy mix, can get back to the 6-7% growth rate that it had before actually the current crisis and the slowdown that was unfolding in 2019 and 2020 already.
So when you were managing public money and when you were allocating money to India, I distinctly remember you were bullish on Indian private banks, couple of IT names, and large blue chip names. Has your preference towards Indian banks or private banks changed, given that there is a slowdown, and if there is going to be marked delinquency in the retail assets, it could lead to derating?
Yep. So I think the private banks that we were investing in are still the cream of the crop. So if the Indian economy does come back, and that would be the reason why you would be investing money in India, I think those banks will do well. Their prices have gone down a lot, and I think they can reverse back very sharply relative to other companies where the drawdown hasn't been as severe. So I think companies like HDFC, they are very well positioned if the Indian economy comes back.
You understand this more than anyone else, that every time we see a crisis, the shape of the market, the leadership of the market changes, which is for the benefit of our viewers. After 2000 crisis, we saw emergence in infrastructure. After infrastructure stocks came down, we saw emergence in consumer and financials. Because of this crisis, how do you think the market leadership or the preference of the market will change?
Well, so I think that's a really good question. And again, that will really depend on the additional policy measures that are going to get implemented. So if the Indian economy actually does have a V-shaped recovery, and I think if there is an economy in the world that has the potential of having a V-shaped recovery, I think the drivers of growth will get back to the same things, and I think the same companies will start doing much better. I think the big difference in 2020 and 2021 relative to, let's say, 2018 and 2019 would be the fact that you are waiting on revival of foreign flows just as much as the growth coming back. And if that's the case, if the large cap companies end up doing much better, because that's where the foreign investors gravitate towards.
You know, everyone is globally saying that go for large caps. Large cap will become mega caps. If that is the order of the economy, I just wonder that what will happen to small companies, what will happen to medium companies, because if they get crunched out, you cannot have a company which only has a handful of large cap stocks. You need a real economy for large caps to do better.
No, that absolutely. I think investing in a market where just the large caps are doing well is basically a cop-out on the part of international investors. That's basically making an allocation into India, hoping that you don't miss out on a potential rally, rather than really good investing. I think the true opportunity in India are probably in some of the highly distressed mid-cap and small-cap companies, and that's where you're going to make serious money if things come back. Unfortunately, in the current environment, most global investors will probably focus on allocation flows and making sure that they don't take too much risk, because there's plenty of risk as is, and may still focus on large caps. But I think from a longer term perspective, mid and small caps are where the real opportunity is.
Mm. You know, everyone is on one side is talking about the steep decline and the pace of decline. It is scary. We can prove on paper this is the scariest we've seen. But do you think in today's automated, algorithm-dominated world, the rise could be equally appealing? Because, you know, when people tell me, look, it's even worse than 2008, my simple submission is that, hey, in 2008, you never had so many algos.
Well, so I think the driver is really not going to be algos. I think algos are essentially riding a particular wave that is being driven by fundamental investors. They are arbitrage opportunities far more than investing opportunities. So I think the driver really is going to be how good the economy is coming out of all of this, and how strong the revival is, and what is the policy mix that gets implemented in the country.
Without getting into reasons of why 2009, 2020 and 2008 is different, I'm just talking about the pattern. In a bear market, US markets historically has fallen about 50%, and it takes about 18 to 24 months, sometimes 36 months for markets to come back to their original levels. So do you think we are in for a long winter, and within that winter you will see a few days of sunshine like we've seen in early April?
Well, so I think if we find a vaccine, or if the summer makes the virus go away for a little bit, I think you may get a very positive reaction out of the markets. Having said that, I think the economic fundamentals are deteriorating, and deteriorating quite rapidly. IMF came out with their forecast today, and they're looking for a contraction in the global economy. In that environment, it's difficult for me to see how we see sunshine every day. This is not, I think for it to be a bull market, we have to see some back-end revival in the economic fundamentals. Having said that, I think there's a case to be made that you can have a slow economy and high asset prices and high stock prices. And I think that really would be driven primarily because the policy action on the monetary side ended up pumping things up. And that is entirely possible, but that's not really a sustainable, long-term, good outcome for the global economy and global asset prices.
Should one in zero, returns are a function of underlying cost of capital and inflation. Cost of capital is almost zero. Inflation is going to remain subdued. In this kind of an environment, mathematically, you could say equity will give better returns. But if I look at the shape of the economy and the problems in the world, it is impossible to perhaps apply this matrix.
Well, so I think that was the point I was trying to make earlier. That is, there is a good case to be made that, let's say, over the next 2-3 years, as monetary policy globally remains close to zero, at least in the developed markets, and that causes significant amount of flows into markets because investment would be low, savings would be high. There's a case to be made for stock prices or other asset prices to be higher. But again, remember, that is not a good outcome for the global economy. And you just have to look at Japan in the 80s to come to that conclusion. Asset prices can go up and they can remain there for a while, but if they come down, that'll be a total disaster and it'll take multiple decades to come out of that.
In your new capacity, perhaps we can take a liberty of asking anything which is beyond your last avatar. Let's say if you have to design a portfolio for someone who's a medium risk taker for next 5 to 10 years, how would you allocate? How much in gold, how much in equities, how much in other asset classes?
Well, so, it really depends on the person's age. So for, let's say, if you had an investing horizon of 20, 30 years, which a 40-year-old person probably does, or a 35-year-old, but I think making a decent allocation into equities, depending on your risk parameters, I think still makes a lot of sense because this is not a typical recession. So, comparing this to something like a depression where prices remain low for a long period of time, or at least the economy remain kind of in a drawdown phase for a long period of time, I don't think that is in the cards. The challenge from an allocation standpoint is the growth on the back of it is probably going to remain low. But I think 20, 30-year horizon, equities, because you're not going to get significant amount of returns by investing in bonds, and therefore equities remain the primary vehicle. So a very decent allocation into equities makes a lot of sense. Gold, to me, I have a real tough time with gold, especially when rates are as low as they are, and it really is an allocation into rates going down more than anything else. And I think that potential is significantly reduced at this point. And same thing with bonds, maybe corporate bonds, but government bonds, at least in developed markets, the returns are going to be very, very low. I don't think the rates are going negative in the US. So therefore, cash probably provides you the same level of protection in your portfolio, and probably provides you a protection against an inflation rebound in case that happens.
Okay, let's talk about India, and I'll take my chances with this one. If you really have to put your finger on 3 companies or 3 promoters you think are doing a great job of running their companies and compounding earnings, which are the 3 companies or promoters you would put your
Well, so instead of talking about companies, let me talk about the sectors and industries, because that would be more appropriate. I think so. Export-oriented companies, if and when things come down or things end, are still going to be good companies to own, because I think if there's a growth revival in the U.S., those companies, or Western countries, those companies would certainly benefit. I think private banks remain a really good sector, because I think even if things, they have some losses, their prices have come down a lot, and the likelihood that the government would let non-bank financials kind of grow massively, I don't think that's really in the cards. If the pharma companies probably benefit a little bit. So I think the opportunity set is for at least, let's say, 6 to 12 months is essentially the same as it was before. But if you really wanted to make serious money and get 3 or 4, 5 baggers, I think for that you have to focus on mid-cap and small-cap companies, and that requires deeper analysis than I have performed.
Fair point. Why do you think one should invest right now? I'm asking you a simple question. Why do you think one should invest in this gloom and doom?
Well, I think one should invest in this in the stock market at this moment, because this is a temporary thing. This is a self-induced coma for the global economy. We will come out of it. This is not the end. The world has endured a lot more, and the capital stock is not getting decimated. The populations are not getting decimated. We will come out of it, and we'll be better as a result. I think the structural issues that the global economy faced, I think some of it may actually get better. I think India is probably the best example of that. If the government was reluctant to implement certain policies, I think this provides them the political cover for them to take really good policy actions to get the economy back on the 7-8% growth track than the 4 or 5% growth track it was on.
Okay, job losses and unemployment would be a reality. That means slowdown in consumption. The problem with India is that it's got a very large unskilled labor class, which perhaps will struggle further. How will this change dynamics for the great Indian consumer story? The India romance for a foreign investor is by consumers. India is 1.3 crore, they will grow. What happens there?
Sure, I think that's a fair point. I think the savings rate as a result of this crisis is probably going to go up rather than go down. So the consumer story probably gets dented a little bit. But I think that dent will probably last at most 6 to 12 months. I think if the incomes get back to the level, it's not like the US, where the consumption story is too large a part of the economy for it to go up from the 67-70% level that we were at. In India, there's still a great deal of potential from a long-term perspective for that theme to come back. So yes, over the next 6 to 12 months, that story may get, the luster may be off a little bit, but I think from a longer-term perspective, I don't think that would be the case if growth comes back and if the government and other policymakers implement a good set of policies to support that growth rate.
So what has worked in the past, which is a combination of private banks, autos, some IT, 1 or 2 NBFCs, you think the same set of stocks will continue to make money?
In the short term, I think, because in the short term, it really would be a flow story, and those flow story gets captured in the top end of the market rather than flow down to the bottom end. But as I said before, the real opportunity in India, if you think growth will come back, is really in mid-cap and small-cap companies where the performance can be spectacular over the 3 to 5 year time frame.
Okay, just 2 last follow-up questions. The shape of the world will change. Social interactions will change. The way we consume and the way we would consume anything will change. World is now getting dominated by more AI and technology companies. So what could be the shape of the world, considering that right now we are interacting digitally? Last night I interacted digitally. The digital world is taking over more. What does that mean?
Well, so I think let's not confuse telecom with artificial intelligence, just to kind of make sure we are talking about the correct thing. So I think what the current crisis has shown is maybe the structure of work that we had gotten used to doesn't have to get back to the way it was. You don't necessarily have to go to the office 6-7 days a week for you to be able to do your job. I think that's becoming clearer. But I think the uptake of AI is going to, I don't think this particular process necessarily accelerates that pace. It was accelerating in and of itself, but I don't think there'll be additional.
Okay, that's Krishna Memani as well, voicing the same opinion that the government needs to announce a stimulus.